I want to start with something that changed my entire view of what's happening right now. Last week, a private research note from Bank of America landed on my desk. Not the public version they send to retail investors, but the confidential analysis they reserve for institutional clients paying $50,000 annually for access. I've seen these notes for 40 years, but this one stopped me cold. It contained three words I haven't seen in institutional research since 2008: policy panic incoming. The note didn't speculate or hedge. It named specific dates, specific price levels, specific allocation percentages that their largest clients were being advised to execute immediately. And what it outlined, sector by sector, trigger by trigger, is the most actionable crisis playbook I've encountered in my career. The note predicts that specific investors, the ones who position correctly in the next 30 to 60 days, will compress a decade's worth of returns into months. But here's what matters. The difference between those who profit and those who watch from the sidelines isn't intelligence or connections. It's understanding the mechanism that transforms war into opportunity and acting before the panic arrives. In 40 years of navigating crises, I've learned one unchanging truth. Generational wealth isn't made by those who predict the crisis. It's made by those who understand what always comes next. Let me be precise about where we stand. It's March 30th, 5 weeks since Operation Epic Fury began. The S&P 500 has dropped 7.4% from its January peak, 5 consecutive weeks of losses. Gold sits at $4,428 per ounce, down 21% from its January high. Silver has fallen over 40%. Brent crude trades at $114 per barrel. The Strait of Hormuz remains under Iranian control, choking off a fifth of global oil supply. Consumer sentiment collapsed to 53.3, the lowest reading in years. Inflation expectations jumped to 3.8%. Walk into any trading floor right now and you'll feel it. The tension is physical. Screens flashing red, voices raised, portfolios hemorrhaging. This is what I call the everything crash. Safe havens selling off, broad markets bleeding, consumer confidence in free fall. Most investors are doing one of two things: panic selling or freezing completely. Both responses will look catastrophically wrong in 6 months. Let me show you why. Here's the mechanism everyone is missing. Bond yields are falling even as oil tops $114. Think about what that means. Wall Street fears recession more than inflation now. Before the war, yields eased on rate cut expectations. The war initially drove yields higher as oil spiked and inflation fears surged. Now they're falling again despite oil at crisis levels. The market has shifted from pricing an inflation problem to pricing a recession problem. And when recession risk dominates, the Federal Reserve pivots from contemplating hikes to preparing cuts. That pivot triggers violent rallies in the most beaten down assets. Bank of America's research calculated the threshold precisely. Oil between $80 and $100 creates an inflation problem. Oil above $100 creates such severe economic damage that recession risk eventually overwhelms inflation risk. We're past that threshold now. The policy panic is building. The note identifies 3 triggers that could release it. First, war de-escalation. A ceasefire, diplomatic breakthrough, or negotiated straight reopening that brings oil back toward $85 to $90. The administration is pursuing strategic petroleum reserve releases and naval escort programs. Trump claims talks with Tehran are progressing. Tehran denies it. But markets watch closely because even a credible signal would unlock what I'm calling the everything bounce. Second, Federal Reserve intervention, not a rate cut. That's politically impossible with inflation expectations at 3.8%, but quantitative easing under a different name. Bond purchases to suppress long-term yields without officially cutting the federal funds rate. This is the tool deployed in every crisis since 2008, when the Fed needed to ease conditions without admitting policy failure. Third, executive coordination. Tariff rollbacks, emergency economic packages, or coordinated allied SPR releases that signal governments are acting decisively. Morgan Stanley's technical analysis shows the correction entering final stages, with RSI indicators flashing oversold signals not seen since 2022. Any one of these triggers produces the same outcome: a sharp, violent repricing upward in assets reflecting pessimism that historical precedent says is excessive. The initial uncertainty has been priced in, 5 weeks of it. Every technical and sentiment indicator is flashing the signal that precedes recoveries, not continued declines. Now let me tell you what the note says about positioning, because this is what they're telling hedge funds while mainstream media runs fear headlines. Sector 1. Energy infrastructure. Not oil companies, they've already spiked. The opportunity is pipelines, storage terminals, LNG facilities, companies that collect tolls on every barrel moving through their infrastructure regardless of oil price. They benefit from elevated prices without commodity risk and from the permanent infrastructure investments the Hormuz disruption is forcing. Sector 2. Defense and aerospace. This isn't about the current conflict. It's about structural government spending reallocation that runs for years after operations conclude. After 9/11, defense stocks outperformed the S&P by 47% over 5 years. Sector 3. Consumer discretionary at peak pessimism. Restaurants, retail, travel, luxury, trading at valuations not seen since the financial crisis. Over half the consumer discretionary index is trading 20% below prior highs. Historically, this valuation depression has produced 14% outperformance over the following 12 months in 23 of 28 instances. That's an 82% hit rate at maximum pessimism. Sector 4. Software and consumer finance. The AI buildout, $300 billion in committed data center investment from Microsoft, Amazon, Google, Meta, doesn't stop because oil hit $115. Software serving this build-out is being sold in panic liquidation that doesn't distinguish between businesses impaired by oil shocks and businesses simply marked down because the VIX spiked. Here's my framework for thinking about this. The same structure banks share only with their largest clients. Separate assets structurally impaired by the oil shock from assets temporarily repriced by sentiment. Structurally impaired. Airlines facing direct fuel cost compression. Unprofitable growth companies dependent on cheap capital, businesses exposed to Middle Eastern supply chains. Temporarily repriced, software unaffected by oil prices, domestic consumer businesses where impact is indirect and lagged, financials benefiting when rates normalize, gold down 21% not because its structural case changed, but because forced liquidation from margin-called central banks created temporary selling pressure, unrelated to the 40-year debt cycle thesis. 3 rules from 4 decades of crisis investing. Rule 1. Don't buy what already spiked. Oil companies and defense stocks made their move. Investors who bought Exxon February 28th profited. Investors buying today are arriving after the crowd, where losses originate. Rule 2. Follow the money, not headlines. Bond yields falling while oil tops $114 is the critical signal. When bonds rally despite elevated oil, the bond market is saying recession risk exceeds inflation risk. That makes the Fed pivot trade, benefiting gold, rate-sensitive stocks, and beaten-down consumer assets, the dominant theme. Rule 3. Remove leverage first. Before positioning in any opportunity, you need the ability to hold through continued volatility. If you're leveraged and the S&P falls another 5 to 7%, which Goldman Sachs says is possible, leverage forces you out at the worst moment. The playbook: remove leverage, position in beaten-down assets with intact structural cases, then wait for the policy panic. Every major oil shock in 50 years created opportunity for investors who understood mechanism over headline. 1973. 2,300% gold returns over the subsequent decade. 1979, defense and energy infrastructure outperformance for years. 1991, when Saddam Hussein invaded Kuwait and oil spiked to levels that seemed catastrophic at the time, investors who held quality assets through the initial panic captured the entire recovery rally that followed within months. 2008. Investors who bought quality assets at panic bottoms made 300 to 500% over the following decade. This crisis will end. The strait will reopen through military action, diplomacy, or Iranian fiscal pressure. Oil will fall from $115. The Fed will cut rates because recession risk forces their hand, or because the debt arithmetic of $39 trillion at 4.4% makes it unavoidable. The policy panic will arrive. Investors positioned before it happens are the sum in this title. Investors waiting for certainty will read about the recovery after it occurred. The S&P sits 7.4% below its January high. Morgan Stanley says the correction may be entering final stages. Goldman Sachs says 5 to 7% more downside is possible if the strait remains closed. Both can be true simultaneously. What matters isn't the exact bottom. What matters is whether you're positioned in the right assets before the panic arrives, because when it does, the move will be fast, large, and will reward early positioning over waiting for confirmation. In 40 years, I've learned one thing with absolute certainty. Confirmation always comes after the move, never before. Watch bond yields, watch the dollar, watch for de-escalation or policy intervention signals. Use that time to position not in what already spiked, but in what moves when the panic turns. The institutions holding that Bank of America note aren't waiting. They're acting now, quietly, while retail investors are still processing headlines. The war will make some investors rich. The question isn't whether you believe that. The question is which side of that divide you'll be on when the panic turns to profit.